Hello everyone, it's Ted Bauman here with your weekly Friday video from Bauman Daily. Thank you very much to Angela Jarrell and Clint Lee for covering for me last week. And on Monday, I was up in Cape Cod with my wife, taking her away for her birthday. Today I want to talk about a very interesting article that I read recently from GMO Research, which is a fairly well-known research house. They're kind of known to be bearish. They're known to be very conservative and cautious, and sometimes they're kind of taken as a punching bag by people who are very pro-growth stocks. But I thought this newsletter was really interesting because it went through, I think, a very compelling argument about why you got to be really careful when you invest or when you overinvest in stocks that are expected to return good revenues in the future. And today I want to go through some of their arguments, not all of them, but the key ones. The great thing is they give us some historical data to use. So let's start by just observing that we've seen a pretty good rotation back into growth stocks after a horrid first half of the year for growth. This year earlier, we saw really value stocks that are generally undervalued relative to the rest of the market, lower PE ratios and so on, outperformed growth, but that's changed. As of June 3rd, the Russell 1000 Value Index was 1.6% ahead of the Russell 1000 Growth Index, but from June, growth rose by 11% and value fell by 7%. Now here's a chart that shows that. So this goes back to the beginning of the year. The blue line is growth and the red line is value. So you see, really from February, when growth pulled back strongly, value outperformed. But starting in May, value really started to trade sideways and growth continued its upward swing, and it's now got to the point where it is once again overtaken it. Now let's just be clear what we're talking about with growth companies. Growth companies are companies that are usually not making a current profit. They're not making enough money, actual cash yield, to justify, you're not going to make any money out of them right now. You might make money out of them in the future if everything goes according to plan in their business plans. So, for example, you get companies, a lot of the companies that did well during last year, like Zoom and others that are growing rapidly, have not yet made profits, and are expected to do so in the future based on all their business plans. We also saw that with SPACs, the special purpose acquisition company. Anyway, it's all those companies that people piled into because they expect their future revenues will be great. And so in a sense, what you're doing is you're pulling forward all that future earnings into the present stock price. Now, one of the reasons why I wanted to raise this issue is because sometimes people talk about stocks as being a value trap. When you say, let's buy a company because it's a value company, it's underpriced. Well, sometimes they're underpriced for a reason. But what GMO points out is that you can also get into growth traps. And in fact, growth traps, which are companies that have high startup prices, high prices at the beginning that don't deliver and therefore suffer a stock collapse, are actually a lot, more common than you think. Here's a chart that shows the relationship between how they define growth trap and value trap companies going back to 2000. Now, understandably, in the early 2000s, just after the dot-com bust, you saw a lot more growth trap companies that had high stock prices and didn't deliver on their long-term trends. But once that worked through the system, the relative balance between the two is almost identical. It really, after 2008, it's just a much of a muchness, as they say in cricket, in the difference. So you're equally likely to fall into a growth trap as you are a value trap. So there's no reason, GMO says, why we should be fixated on value traps and ignore growth traps. In fact, there's a good reason not to do that, and this next chart shows why. And it's because growth traps are much more expensive mistakes to make. This chart shows essentially the annualized return or negative return that you get from investing in a company that's a value trap, in other words, a company that was cheap for a reason and doesn't get any better, versus companies that were overvalued and end up not delivering on their promise. You lose more money on growth traps. So the question is, now that we've seen growth rebounding after a poor first half of the year, should we revert to growth? I get emails from people all the time saying, hey, I hear what you're saying. You talk about ARK, you talk about Cathie Wood, you say Tesla's overvalued. You're wrong. You're the one who's going to end up with egg on your face. Well, no, yeah, last year I definitely made a mistake in thinking that, or discounting, if you like, the effect of the Federal Reserve's impact on those stocks. But in the longer term, I think I've been proved right, because once that was all baked in, growth stocks began to fall. Question is, where do we go from here? Should I go back to growth stocks? Well, I've got some growth stocks in the Bauman Letter. I definitely have a lot of them in my profit switch portfolio, but they've had a hard time this year. Now they're starting to turn around. Do we double down? Well, let's talk about that. GMO advances a couple of arguments. They play devil's advocate, and I want to go through some of their arguments because they're really good. The first one is that value's outperformance at the beginning of this year was due to the economic reopening from COVID, and which is largely over with and is going to reverse. And without that tailwind, growth should lead again. The problem is, as they show, there really is no general long-term pattern that shows that growth outperforms value in bad economic times or good economic times. The chart that I showed you earlier showed that you're equally likely to end up losing with value stocks as you are with growth stocks, no matter what the economy is doing. And of course, if you lose with growth stocks, you lose harder. It's the old Jimmy Cliff thing. The harder they come, the harder they fall, that sort of thing. Bigger they come, sorry. The second argument they make is that growth is rebounding because the market thinks interest rates will fall further. In other words, that's their second devil's advocate argument. Fed Chairman Powell last Friday certainly kicked off at least a short-term boost in growth stocks, which we've seen all week, by indicating that an interest rate hike was definitely not on the cards. There might be some tapering starting at the end of this year, but it's not really an issue because right now the demand for additional liquidity from the markets is just not there. In fact, as I pointed out in my Bauman Daily article on Tuesday this week, banks are actually paying people to take money from them. They have too much money. So the taper issue is not a big one. The interest rate one could be, but here's the thing, and this is where I like GMO's thinking. They say, why should rates fall any further, right? Because remember, for growth stocks to do better, for them to grow to higher valuations than they already are, you can't just assume that interest rates stay low. You have to assume that interest rates will go even lower than they are. So the question is, why would that happen? If anything, we're almost at the zero bound. So really, there's no reason to think that interest rates would be going any lower, and therefore creating additional reasons for more multiple expansion, higher PEs from growth companies. And anyway, they say, why would anybody want to bet their portfolio around that assumption? It's just not a safe assumption. I think that's a pretty compelling argument. Now, the third argument they make is, or rather the devil's advocate argument they admit is a pretty strong one. They say, well, maybe growth stocks are not as overvalued as people think because generally agreed accounting principles or GAAP accounting hasn't kept up with business practices and business models that rely more on intellectual property than tangible assets. What that means is that if you look at the book value of a company, in the old days, if that company was Exxon or Ford or GM or any other company that had lots of plant, lots of equipment, all that kind of stuff, then you could see that the book value of the company, the value of its assets, what it could get if it were liquidated, was a lot higher than a lot of today's companies. And because really they haven't not figured out how to incorporate intellectual property and the value of the thinking that goes on in a company like Amazon or Google into the price. And so what they're saying is that price to book is no longer a reliable indicator. Well, let's look at that. Here's a chart that shows the relationship between price and book. The price to book value going back to 2000. Now, again, it was pretty high in 2000. And, back then people made the same argument. They said, well, it's because all these .coms have a tremendous amount of potential value because of their intellectual property. Well, we know how that worked out if you bought pets.com. So that fell, and then it kind of traded. It was in a range for a long time. It fell after the great financial crisis, and then it gradually rose again. But in the last year and a half, since 2020, it has skyrocketed. So the current price to book right now is 4.84. That's the multiple. So in other words, the average in the S&P 500 is that the price to book ratio is nearly 5 times or the price of the average stock is nearly 5 times its book value. Now, the long-term mean you see at the bottom is 2.89, the median is 2.79, the minimum is 1.78, and the max is 5.06, which was back in March 2000. So really what we're seeing here is a situation where we are near the top of the historical trend in terms of price to book value. Now, you could argue that if we were to be better at valuing economic, or rather intellectual property, that would actually ease some of those concerns. Again, the same argument people made back in the dot-com era. So let's look at another measure, the measure that you use particularly for companies that have not yet turned a profit, and that's price to sales. Here's a chart that shows price to sales, again, going back to 2000. And straight ahead, we are at the very, very high. We've blown everything away. So right now, the average price to sales in the S&P 500 is way, way above the historical mean of 1.65. It's really at this point, it's at its it's above its most recent maximum of 3.26. This chart is up to date. It's based on today's trading, but in June it was 3.08. We're actually bigger than that. So why does price to sales matter more? Well, price to sales is much more reliable than price to book when it comes to assessing growth companies, because that's all you've got. If you say that a company is worth a lot because it's going to generate more sales, then you would expect that its price to sales would gradually fall because as the sales increases, the price has to, it'll come into relation to the price at a more reasonable multiple. So if that's not happening, then, we got a problem, because it means that those multiples are expanding faster than the revenues. And that shows you that you might fall into a growth trap where you buy a stock at an expensive valuation because you think it's going to do well, but in the end, it's just not worth that much and you lose a lot of money. Now, this leads to the fifth argument, devil's advocate argument that GMO makes. They say growth companies, people say, are just better companies. They're destroying old companies and are changing the world. I won't name any names, but we hear that argument a lot, even here at Banyan Hill. You'll never make 10 times your money in value stocks, whereas some growth stocks have risen well over 100-fold in the last 20 years. Well, that's true. If you invested $1 in Amazon in 2001, you've got $267,000. Or sorry, $267 per share 20 years later. So basically, Amazon has grown by that amount. I mean, from 1 to 267, that's great. But however obvious that may appear in retrospect, picking winners is a hard thing to do. And the consequences of not getting it right are severe, all right? Now, in this respect, and I think this is where GMO is really clever, he says buying a growth stock is like buying a winning lottery ticket. You only know they're winners afterwards, and they don't give you any guide to the future. You can't say that just because Amazon does this, that ergo another growth stock will do it. It all depends on the company. And the reality is that investing in anything that takes like an extraordinary turn of events, like Amazon turned out to be, in order to earn a good return, is generally a bad idea, even though there are exceptions to the rule. Now, here's their sixth devil's advocate argument. If you buy enough of companies like this, your winners will cancel out your losers. Well, that may be true in some circumstances. If you'd bought a lot of potential growth stocks just after the great financial crisis, Google, Amazon, Facebook, etc., you've done very well for yourself. But when all growth stocks as a group are overvalued, your chances of coming out ahead dramatically fall. Right now, 25% of stocks are trading at 10 times sales or more. Here's a chart that shows that. Right now, the number of stocks, 25% of U.S. companies listed on the S&P 500 are trading at 10 times sales. And you can see that jumped up dramatically after 2020, which is when the Fed started pumping money into the markets. Now, there's nothing about 2020 or the Fed that should show us that the long-term trend for growth stocks has changed. This is just a question of easy money. Now, there may be some companies that come out of the COVID crisis that'll do very well. Maybe Zoom will take over the world. It will never go to work again. We'll all just Zoom, and Zoom will figure out a way to monetize that. But realistically, we're so far above the long-term trend that it would take a remarkable turn of events, one that we've never seen before, at least going back to 1980, to sustain this level of valuations. Now, here's the problem. Historically, companies that have traded at 10 times their sales, in other words, their stock price is worth 10 times their per share sales value, have underperformed the market by 4% per year relative to value stocks. Here's a chart that shows you the result. You could do just as well. You see that red line there? That's the U.S. aggregate bond index. The green line at the bottom is the real return for companies trading at 10 times sales, basically price to sales. And then there's the rest of the market. You don't have to be a mathematician to figure this one out. You'd be just as well to invest in bonds, even at the low interest rates that we've seen since the 1990s, the falling interest rates, than buying companies that are trading at 10 times price to sales. On the other hand, buying companies that trade at less than that would have given you a potentially annualized return of 8.7%, which is excellent. Now, what that tells us, or what that means, is it all comes down to multiples. Multiples are what run up in euphoric periods of boom times. Here's a chart that I showed before on Your Money Matters, and it shows, going back to the beginning of the 20th century, the components of the increase in stock market return. Now, most of the time, in between boom times, most of your return comes from earnings growth and dividend yield. So, and when we talk about yield, we're talking about, what you get, even if it's not paid out to you, what you get as an owner of a share, whether that money is paid to you or reinvested by the company's management back into the company's activities. Now, generally what happens is that after you get a pullback like the one after World War I, people get enthusiastic, and the biggest component of return over the short term is increase in multiples. People are willing to pay more. They're willing to bid the price of stocks up in expectation of future growth. We saw that just before the great the great stock market crash in 1929. We saw it in the 1950s. We saw it in the 1990s leading up to the great financial crisis, and we're seeing it again today. But look at the pattern. Once that's done, then you get a reversion. You get a big pullback in PE. And that's the reason why, even over shorter time periods, stocks that are highly overvalued, like over 10 times sales, are really just not a long-term bet. Now, don't take it from me. Take it from somebody who actually saw this happening in action. I'm actually going to quote this. It's not really a quote, it's paraphrased, but it comes from a guy named Scott McNealy, who was the co-founder and CEO of Sun Microsystems. He said this to Bloomberg in 2002. He said, and again, to paraphrase, 2 years ago, we were selling stock at when we were $64 a share, 10 times revenues. At 10 times revenues, to give you, the investor, a 10-year payback, you have to assume I can pay you the 100% of revenues as dividends for 10 straight years, and my shareholders will be okay with that. I have zero costs of goods sold, no expenses of any kind. I pay no taxes. I can maintain my current revenue run rate despite doing no R&D for the next 10 years. He says, so would you like to buy my stock at $64? Do you realize how ridiculous those basic assumptions are? Getting crashed in my stock isn't about corporate transparency. You don't need more footnotes in our reports. What were you thinking when you bought the stock? I leave you with that. Now, this is not a bearish take on my part. I'm not saying that the stock market's going to crash. I'm not against companies doing well. My point is that buying growth stocks willy-nilly, particularly stocks that are trading at 10 times sales, historically is a very, very bad idea. Because as I pointed out earlier, it's basically the same thing as buying a lottery ticket. You might win, but you won't know until afterwards. And the fact that Amazon did it doesn't mean somebody else is going to do it. And historically, if you make those kind of bets on those highly valued companies, no matter how many of them, how broadly you spread it, at times like these, when we're trading at these kinds of multiples, you are more likely to lose. So my advice, as it has been all year, is look for those dividends, look for that cash yield, look for quality. I still think there are good gems out there. I'm looking for them all day, but you only find them through the fundamental research that confirms that they are more likely than not to deliver on the growth model and the business plan that has justified the high prices that they're earning. Otherwise, you're going to lose your money. This is Ted Bauman signing off. See you next week.